IFRS 15 is the concept of highly probable not reversing. I mean, it sounds to me like it's very academic, doesn't it? To try and model your variable revenue, in other words, the roaming charges, because part of those roaming charges on your phone will be booked as revenue on day one to the phone, right? So we're moving to a very aggressive approach, in my view.
It is same as it was in previous standard, that if we can make a reliable estimate. Previously we used the words reliable estimates, now we are using highly probable.
But the difference to me is in IAS 18, we weren't taking and booking revenue before we could actually invoice it generally. We would, like for example, with the phone company, we're taking roaming charges from 3 years from now, booking it today as revenue to the seller of the phone. Some of it is a bit too aggressive, I feel. So we're probably going to have a period of readjustment. Every time we come up with these new standards, we have new frauds, right? You know, and there's so much creativity now in accounting. If you speak to the really old people, you go to a course and you have like the 70-year-olds on the course. They look at their heads and they say, this is nonsense. You know, the concept of prudence. Prudence doesn't exist anymore, right? They say, they look at this and they just laugh at you. So a couple more things on IFRS 15 that are to be aware about. So, again, the issue in IFRS 15 tends to be when you have performance as at 2 points of time, on day one and in the future. So you have, usually you provide a good with a warranty, or you provide a phone with a service, with the phone calls. And the issue is basically how you allocate revenue on day one and what revenue is deferred. So from the auditor's point of view, they're going to be obviously more concerned that you're bringing revenue forward. And from a client's point of view, it's an opportunity to make yourself look better today, but the quality of revenue is not as good. So what is the difference between a contract asset and a financial asset? Don't look. Which one's better?
Financial asset.
Okay, what's the difference? You're sleeping. What's the difference?
For the contractual asset, we are bound to providing service or good. For the as in the financial asset is in cash terms.
Hold on. So what is a contract asset?
That is settled against performance obligation.
Can you give me a better definition?
When you have unconditional right to receive.
No.
That is a financial asset.
Correct. So the way I look at it is a contract asset, it means I booked the revenue, but I can't invoice you. Isn't that pretty aggressive? We're booking revenue, but there's no invoice. So I booked revenue on day one for the phone sale based on roaming charges. But because I can't invoice you for the roaming yet, it's a contract asset. Make sense? So contract assets, in my view, are extremely aggressive. As an auditor, I would be concerned about the contract assets being overstated more than the financial assets, because those could be reversed later. If there's no roaming charges, what happens? If you write off the contract asset, you take a hit. You take a hit the current year for revenue from the previous years. A couple more things. So contract modifications, this can be a pain in the neck for some industries. Again, telecom industry is a classic example. So what happens is you have a family plan. For example, you have a husband and wife, and then you have maybe 2 kids on a family plan. And so you get a couple of phones and everything. And then the husband drops the phone in the ocean because he's a bit careless. And he goes to the phone store and he says, I want another phone. And they give him another phone. They say you have to extend the contract for 6 months. That's a contract modification. Now the hardest part about contract modifications is to get the system right, how to deal with it. So what we basically say, if the contract modification is not approved, you can't do anything. So the big emphasis in IFRS 15 is kind of like US GAAP here. The contract has to be signed. or it has to go through whatever the normal process is for approval. If it's a text message, if it's a voice confirmation, whatever the formal process is. So if the contract isn't approved, you can't do anything. If the goods are distinct, then it's a separate performance obligation. But if the goods are not distinct, you have to go and redo the previous allocation of revenue going forward. So it's basically a lot of work. So this is kind of a major issue. So does it add distinct goods or services that are priced with commensurate with standalone selling price? So for example, if you give a phone for free in the middle of a contract to extend it, it's going to require a recalculation. If you give a phone at full market price, that's different, but the phone companies usually don't do that. It depends on the market you're in. And basically, if the remaining goods and services are distinct, you have a termination in a new contract. Otherwise, you have to redo the calculation. So I find this one is an interesting one. The other thing that is interesting here is, we spoke about this yesterday, we have a new category of an asset called a right of return asset. So what's the difference between IAS 18 and IAS 15 when it comes to inventory we expect to be returned? Remember?
We didn't book inventory receivable. We just adjusted sales returns.
So under IAS 18, the common practice was to use IAS 37 and to provide for the unrealized profit. That's it. Under IFRS 15, we actually knock out the unrealized profit, point 1, and point 2 is we put the inventory back into our books in a separate inventory account. There's another thing that was different between IAS 18. Remember the third thing on inventory at the customer?
We told that there are two types of inventories under IFRS 15. One, the normal inventory, and the other, the right to operate on it.
Correct, but I mean, in respect to the other thing that's different, under IAS 18, if you sell goods to an intermediary who then sells them to the final customer with the right of return, you would wait to book revenue until it was sold to the final customer. Remember this? Under IFRS 15, it's a bit more aggressive. Under IFRS 15, it doesn't matter if you sell goods to the final customer or to an intermediary.
But if the intermediary is not taking any control of the assets, just acting as an agent.
That's a different issue. That's a different issue. But if the intermediary takes control of the promised goods or services, then you transfer the PO to the intermediary.
But then in IAS 18, we, I think, applied the same principles, even if we were selling to intermediaries. We treated them as customers then.
Well, but the revenue was deferred until it was sold to the final end customer.
That depends upon the arrangement, right?
Correct.
Many companies here who sell to distributors, and the distributors take on the entire risk related to inventory.
But my point there, if the inventory is sold with a right of return, so you sell to a distributor, and you tell the distributor, whatever you don't sell, you can give it back to me.
Then that's a different story.
That's the story I'm talking about. So under IAS 18, if the distributor can give you the goods back, you wouldn't recognize the revenue until the goods went to the final party. Under IFRS 15, it's different. If the goods go to the distributor, it doesn't matter if it goes to a distributor or a final customer. What matters is the new concept of variable consideration. Is it highly probable of not reversing? You can book it. So it's a different calculation. So the emphasis in IFRS 15 is all about highly probable of not reversing. The emphasis of IAS 18 is the type of customer, a final customer or an intermediary customer. That's very different. So that's this aspect here. Breakage, it's pretty similar to IAS 18. So the classic example, go ahead.
If the return of goods is more frequent than it was planned, then can
Change in estimate, IAS 8.
okay, then we'll change it.
Correct. So at the time of booking, the question is it highly probable of not reversing? which means it could still be wrong. Because highly probable is 70%, which means there's a 30% chance it could be wrong. So that's not a problem. It's just a change in estimate.
But it's definitely manipulation.
Correct. Correct.
So we have been discussing that we have gone way too aggressive with the IFRS 15.
And
Was
9.
it not considered at the time of formulating it? Or?
I think what's happening, in my opinion, is the accounting standards are ahead of the accountants in some ways. Because the problem is, if you look at the example of a phone, does it make sense to say you sold a phone at a loss? Not really, right? So what the phone companies used to do is say, we sold phones at a loss. And how can you sell a phone at a loss? You might do it once because you made a bad decision, but you don't do it all the time. So I think what the standards are trying to do, what analysts are trying to do is say, let's show the reality. So we're trying to move to the reality, and in doing so, there's some growing pains. I mean, there was a discussion paper about, I get my years all wrong, maybe 8 years ago, 10 years ago, where they were proposing to take all liabilities and fair value them. In other words, to take provisions and fair value them. Now, conceptually, that sounds great, doesn't it? But try to imagine the calculations to fair value your provisions. To make everything like the cash flow statement. So the cash flow statement has operating, financing, and investing. And about 10 years ago, they said, why don't we make the balance sheet have operating, financing, and investing, and the income statement have the same. Remember that one? So there is this, I think what we're going through is a period of time now where the analysts want us as accountants to give them better information, and we're having trouble to do it correctly.
Basically, it's a shift from prudence to true and fair.
Yeah. But
Maybe we are doing it, as you said yesterday, that we are doing CFA job for them. Like, I mean, since they are going to analyze it this way anyway, we want it to be done.
exactly.
But
I mean,
those are estimations or future valuations of the companies and whatnot, which does not meet directly the actual. They may be doing well off 5 years down the road, and then they want to analyze it that way, and they are doing accounting for accounting, so that's not going to.
but I mean, the classic example, if you're an analyst, you want to have your cash match your income, match your assets and liabilities of that section. So you want your operational assets, your operational cash flows, and your operational profit all together. And the problem is when they suggested this, the standard setters issued a discussion paper exposure. I think it was a discussion paper. I can't remember if it was the ED or the discussion paper. And the analysts loved it. But the accountant said, hold on. If I take your cost as an accountant, where does it go? You spend a little bit of time on investing, a bit of time on financing, a bit of time on operational aspects. It's split, right? It's a whole different mindset. So my feeling is we're going through a period of time where we're going through all these changes with a lot of experimentation. And IFRS 9 is a classic example. It was done in IFRS 9. What was sad about IFRS 9 is the US and FASB agreed to come together. The idea is let's converge. You can't have a global economy with two systems. Let's be realistic, right? So then we converged on IFRS 15. We did a very good job there. IFRS 16, we didn't converge. And there were reasons for that. The US was more concerned about the capital markets, and IFRS was more concerned about keeping it easy. Then we come to IFRS 9, we completely went different directions to a very rule-based, silly model that gives the auditors a lot of work and big bonuses to a principle-based model in the US, right? So we're in this transition phase, which means there'll be a lot more changes. So we're in a messy period, right? That's reality.
Can you give an example of,
Speak louder, please.
can you
Yeah, I can. Like example 2. If you look at example 2, page 96, I don't have time to do many examples anyways. Example 2, so this is on page 96. So they have sold 100 contracts. Each contract is sold one marble table for $100. Payment is made at time of transfer, and they can return any unused product. It costs $60. It's estimated 97% of products will not be returned, so 3 will. So what's the accounting entry for this one? Okay? So what we would do here, and there's really good publications, by the way, from all the big 4 on revenue and leases. There's excellent publications on these. They give lots of examples on these as well. So we would debit receivable or cash, 100 times 100. Is 10,000, right? Okay. Revenue would be 9,700, right? And we'd have a refund liability of 300, okay? So these are financial instruments, right? They're not contract assets, they're financial instruments. Okay? Then we would debit cost of goods sold would be 60, right? Which I believe is 58.20. We would debit a return asset, which does not have to go on the face of the financial statements, which could go in the note disclosure. So when you have your inventory, you have, finished goods,